Trustee Jarity, would you like to lead us in the Pledge of Allegiance? To the flag of the United States of America, and to the republic for which it stands, one nation, under God, liberty and justice for all. The MSERA board meeting for July 17th is called to order at 8:30 a.m. Roll call, please.
Mr. Kelly? Ms. Cavanis?
Here.
Mr. Jarity?
Here.
Mr. Cromer?
Here.
Ms. Harris? Ms. Pierce?
Here.
Mr. Shoemaker, Mr. Swope, and Mr. Land are all absent by prior arrangement.
Members of the public are welcome to address the board on subjects both on and off the agenda. Do we have any members of the public wishing to make comments at this time?
There is no public comment.
Does any trustee wish to pull an item from the consent agenda for discussion? The consent agenda is approved by unanimous consent. Agenda item 2, we have Dodge and Cox. Presenters are Dustin Seeley and Alexander Charts of Dodge and Cox and Robert Riveles.
Trustees, we have two reps from Dodge and Cox here. They're going to provide a performance update and a educational session. And I'm going to attempt to run the presentation for them. Let's see if I can share.
Okay. Well, thank you for that, Robert, and thank you all for having us here to present. My name is Alex Charts. I'm a vice president and client portfolio manager at Dodge & Cox. I'm working mostly with our institutional fixed income clients. And I'm joined by my colleague, Dustin Seeley. Dustin is a vice president and a structured products analyst and trader. So, I was going to plan on starting out by just providing an update on the income fund, talk a little bit about performance, and then I'll turn it over to Dustin to provide more of a deep dive on structured products. So why don't I get started here? There are two decks. So this is the Mendocino County Employees Retirement Association deck, if you're following. There are a handful of slides here that are more just about, kind of an update on Dodge & Cox. From kind of a high-level standpoint, we are an independent organization. We're 100% employee-owned, so we're really focused on clients. We're not responding to any kind of outside parent company or shareholder, really focused on making the best long-term decision for clients. We have one business, and that's really just managing clients' assets. I'm going to skip a couple pages here on our assets under management and the team and process. I'm happy to provide any background on that if anyone's interested, but just for purposes of moving this along, I'm going to focus more on the income fund. So, Robert, if we could move to slide 12. This is our U.S. bond market yields and sector returns exhibit. And what this does is really just provide a snapshot of what has transpired in fixed income markets over the past 12 months. If you look to the upper left there, you can see that yields, especially at the long end, are higher on a year-over-year basis. Moving to the right, you can see that the path of yields over the past 12 months has been a little bit bumpy. The 10-year yield is in light blue. It's mostly masked by the 30-year, but you can see it's fluctuated from kind of under 4 to just under 5 over this stretch, and it's largely been driven by market expectations around Fed policy, and every inflation print is a big component of that. So going back, earlier this year, you saw a handful of hotter than expected inflation prints that kind of pushed out the timing of when the Fed was likely to cut. More recently, you've seen some progress on inflation. So the narrative has switched somewhat, and it seems more likely that we are going to see 1 or 2 Fed cuts later. In terms of other risk markets within fixed income, if you look to the lower left, this shows the credit index, and it's showing the OAS, so option adjusted spread. Another way to think about this is the yield premium for investing in riskier assets than Treasury. So this is the additional yield that investors earn for taking on that risk. And higher levels of it indicate more compensation for the perceived additional risk. That level has decreased over the past 12 months. Overall risk assets have performed well, and credit securities are no exception to that. Part of it is, corporate fundamentals remain strong. There was talk of a recession going back last year. That's mostly not part of the conversation now. So generally, there's a lot of optimism about just the health of corporate securities. And then looking at sector excess return, so this just shows the outperformance of different sectors versus treasuries. So treasuries, obviously, that's the risk-free. But if you invested in, say, corporate securities over the past 12 months, you would have earned an additional 3.7 percentage points. So obviously better to be in corporates or asset-backed securities, for example. So hopefully that just provides kind of a backdrop of what's happened over the past 12 months, and kind of sets the stage here for the performance results exhibit. And I'll mostly focus on the past year here, but if we advance to the next slide, you can see the 1-year return for the income fund was 4.54%, representing outperformance versus the benchmark, the Bloomberg US Ag, of almost 200 basis points, 2 percentage points. So we're pleased with that outperformance. I'll talk about some of the factors that influence that. We do focus more on the 3- and 5-year numbers, and really even 10-year. We're a manager that takes a long-term approach. So we're always looking at what are the range of outcomes over a longer-term investment horizon. So certainly pleased with kind of the year-to-date 1 year, but we mostly focus longer term than that. I'm going to skip the quarter for attribution and focus more on the year. And what this does here is really attempt to disaggregate that 1.91% of outperformance into 3 main categories here. So security selection, asset allocation, and then duration or yield curve. The largest contributor for the past year was security selection, adding 109 basis points. And that's what you would expect to see from us. We're, at our heart, we're a security selector. We're focused on identifying securities that we think are underpriced, buying those, holding them until the market realizes what we think is appropriate pricing. Asset allocation also added meaningfully to relative performance over the past year, adding 79 basis points. In particular, we were underweight treasuries and overweight financial institutions and industrials. This gets back to what I was mentioning earlier about being in corporate bonds was better than being in treasuries last year. So that added to returns. And then on the duration yield curve, we were underweight duration for most of the year in a period where rates rose over that stretch. So we had less exposure in the portfolio to rising rates. Which, when rates rise, that puts downward pressure on prices. So from a relative performance standpoint, that was positive. If we move to changes in the portfolio, we've been pretty active in the portfolio over the past year. If we could advance past the quarter, I think I want to focus on a little bit longer term. So if you look to the summary of credit changes in the upper left, it shows the starting weight in credit. So 44.5% starting weight in credit securities in the portfolio. Over the past year, we added a little bit, but we were mostly reducing this exposure. So we added 1.2 percentage points. We trimmed roughly 10%, and on a net kind of change basis, that reduced the portfolio's credit exposure by 9 percentage points. The main reason we've been reducing the portfolio's credit exposure is just that we think the yield compensation there is not appropriate. We think overall that part of the market is overvalued, too rich. And some of the securities that have performed well in the portfolio, we think there's less room for them to continue to improve from there. So we took this kind of strong performance period as an opportunity to reduce some of those positions. If you look over to the right, this shows the largest change in credit exposure over the past 12 months. In terms of themes of these names, they were typically names that were trading just on an OAS basis that I mentioned earlier. They're trading tighter than what we would expect given fundamentals. We also trimmed more of industrial securities. Financials have remained somewhat more attractive, kind of on a relative basis, since the regional banking turmoil of last year. So we still find some value there. For some of the industrials, we're a little more wary of taking on that credit. At the same time, we have identified kind of one-off opportunities. UBS and Raytheon are two examples of securities that we purchased over the past 12 months. Those were both purchased last year, back half. So while we have, and then I mentioned all these credit trims here, we've mostly been adding the proceeds of those credit trims to treasuries. So really just building up dry powder in the portfolio if there's a period of volatility and quickly deploy assets. And we've also been adding to the securitized weight, so agency MBS and asset-backed securities, which Dustin will focus on shortly. If we move to the portfolio structure, this shows kind of a snapshot of the current portfolio. And so if you look to the upper left there, that sector composition, the income fund is in brown. So we've been adding to treasuries a little bit, but we remain significantly underweight there. And on kind of a long-term basis, we don't think it's appropriate to have a significant amount of treasuries. We want to be able to generate returns in excess of the benchmark, and the way to do that is to take prudent risk. it's not to have kind of a benchmark weighting in treasuries. That's the reason that we're underweight treasuries. Securitized, we're meaningfully overweight. This is an area of the market that we think is really attractive right now. These are all agency securities, so they have the government rating. They're very high quality, very liquid. They offer meaningful yield over treasuries, and we think, particularly for mortgage-backed securities right now, the risk is is prudent to take on. It's in our view, kind of when you look at the prepayment assumptions for the mortgages that are out there, they're very low. Most borrowers have zero incentive to refinance right now. 97% of the mortgages out there are so far below where current rates are that no one is likely to refinance. So we like that kind of component of what makes MBS attractive right now. And then if we stay on this page but look down towards the weighted average summary characteristics, a big part of our investment philosophy is building in a yield advantage versus the benchmark. And if you look to that yield to worst there, 5.5% versus 5.0% for the ag, 50 basis point yield advantage is a nice tailwind in the portfolio. It's been a big driver of our outperformance over longer term periods. So part of the reason we're able to build that in is we're overweight some of these sectors that offer more yield than treasuries. We also invest in securities that have a higher yield than their sector. So for example, within corporate securities, we're investing in securities that have a higher yield than the broad corporate securities held in the benchmark. That's the way that we're able to take advantage of all the research that we're doing. We think it's appropriate to take on that additional risk. There's a slide here, portfolio composition by theme. This is really just a way of looking at the whole portfolio. So it's a pretty transparent portfolio. Everything that we hold in the fund is on this page. You see credit at 35.5%, securitized, moving over to the right, securitized at just under 49%, really kind of on the lower end of where you'd see us with our credit weighting, looking over the past, say, decade, and on the higher end of where we've been in terms of that securitized weighting. And it's really just a reflection of kind of where we see relative value right now. There's a couple more slides here on credit holdings by sector and mortgage-backed securities that I'm probably going to leave for you to review separately. I want to just close with some comments about our outlook and kind of how that is impacting portfolio positioning. So right now, we think that we're kind of in the midst of what's referred to as a soft landing. So we think that growth will continue to taper off, kind of in line with expectations of around 2% growth in the US over the next couple of years. We think inflation will continue to come down. We've seen some nice progress on that over the past couple of months. Seems like, I know the Fed has their 2% target. We think it'll fall into a range of slightly above that, maybe 2 to 2.5% looking out over the next year or so. It's not going to get there right away, and path is going to be a little bit bumpy. We think there's a good case for the Fed to cut once, possibly twice this year, and continue along that pace of cuts over the next couple of years, and really achieve this soft landing. That's their ultimate goal. So with that, why don't I pause and just see if there are any questions?
So we have investments in two different mutual funds of bonds or fixed income. And one is PIMCO has several, but the one we have has underperformed your fund for some time, maybe slightly after we got into the PIMCO fund. But PIMCO has another fund that looks, in my mind, a little closer to this fund, if I'm reading it correctly.
Okay.
This fund, it looks like it's about half of the assets. Looks like they're in securitized. So is that mortgage-backed securities, that kind of investment?
Yes.
So the PIMCO fund that we don't invest in, but looks more like this one that has 50%, up to 50%, and it's securitized, actually had a even smooth, so your fund had a smoother ride than our PIMCO fund in the 22 drawdown. So
Okay.
your fund drew down, according to Morningstar, I think it was about 10% in 2022, whereas the PIMCO fund, I think, dropped 12 or more percent.
Right. Yeah.
But the other PIMCO fund that looks more like this had an even smoother ride, and right number, it looked like it drew down only just under 8%
Okay.
in 2022, and actually had, over a 10-year period, had an even better performance. So when a portfolio, and in this case it's a pension fund, chooses to have more than one bond fund or more than one fixed income fund, we're being told we need to pick two different fixed income funds that have different characteristics. I'm not entirely sure we need two different fixed income funds, or that they need to be that radically different, or that they in fact are that different, the two that we have. But what would be your advice to a board like this into, like, if we were to take two fixed income funds, why should we have two? What would be the two characteristics we'd be looking at? Or should we just go with one fund?
So thanks for the question. I want to be careful about not providing investment advice regarding that.
Let me jump in
Okay.
and say that's really a question for Callan, or, I can certainly give some of my own thoughts on that, but that's not necessarily something that we would want an investment manager to opine on, right? Because there's pretty big conflict of interest about what they would say, which is give me all your money. So that's somewhat inappropriate question.
Yeah, I don't think it's inappropriate. I think it's information for the board. So you can answer however you want to answer.
Okay.
But so we are invested in this one fund with Dodge & Cox. It is highly rated by Morningstar and other sources. Is this the fund with Dodge & Cox that you think we should be invested in? And if so, why?
So this is our flagship fixed income fund. So yes, I think it makes sense, considering the board's objectives, to be invested. To your question earlier, I think there are trade-offs between diversifying between two managers. It's two managers that someone has to monitor, so it's downside. But assuming there are two managers that have complementary features, I think it can be beneficial. So slightly different styles, maybe different portfolios, different ways of outperforming over the long run. It's hard to know also whether, just looking at kind of high-level characteristics, how similar they are based on a securitized exposure. There's a lot of security selection that goes on under the hood, and many managers do it well.
And then my follow-up is, so we hear from our actuarial company about what they're looking for in long-term returns. We also hear from Callan, our financial advisor. But I think it's also interesting to hear from the fund managers. What do they project as our future earnings from the fund that we're investing in? So we saw what the returns were. We can look backwards and see what returns were. What do you project forward for the fund as far as you can project? And I guess both in absolute return and also in excess of the Bloomberg aggregate, which that's obviously why we're choosing to invest in an actively managed bond fund or fixed income fund, is because we're hoping to beat the Bloomberg aggregate index, and which the fund has, both funds, both the PIMCO and this Dodge & Cox.
Right. So with all the usual caveats around not kind of predicting performance or guaranteeing anything. I think looking at the yield to worst of the fund and the index, so 5.5% and 5, is a pretty good proxy of performance that can be attained over the next couple of years. Of course, that's kind of holding everything constant, but that's kind of what we look to internally, kind of a proxy.
So is that net of fees? Because you know, we could go for a cheap Bloomberg aggregate index and pay less than 10 basis points. This is 41 basis points. I mean, that's 30 basis points right there.
Right.
That's the difference. So just trying to understand what's the advantage we're getting by having the active managed. Is it less than 50 basis points?
So what I just quoted you is not, it's without fees. So obviously fees would be lower, as you were alluding to. The benefits you get of active management are that the possibility of outperforming more than that, being nimble and adjusting to the markets. I think you know, if you look at historical performance, that's something that we've been able to achieve. So it's, you know, this is a good proxy here, this 50 basis points here. I think if you look back, we've outperformed even that.
I think when I looked back, it was about 100 basis points, almost 100 basis points, I think, over a 10-year period.
Mm-hmm.
So I would also jump in and sort of point out one other thing that has changed over time. As the Bloomberg Ag has changed over the past few years, both of the managers were short duration. So that's sort of another aspect of changes that we've seen happen. And now we see on one of the slides here, there's a slight overweight, 10 basis point overweight to the Bloomberg Ag. So in addition to that higher yield, there's a little bit more of this. My perception of it is basically potentially prepping for some kind of rate cut. And you sort of talked about that with some of the sector changes that you've had. So in addition to the yield portion of the income, there's this other appreciation portion that the fund is preparing for.
That's right, Robert. Thanks for that. We did add slightly to duration when the 10-year was at 4.7 or so back in April. That's the most recent adjustment duration. And it is a reflection of what you mentioned. We think rates are likely to continue to decline in the next few years.
Yeah, Alex, you had made a comment in responding to Trustee Jurdy about being nimble and making these adjustments.
Mm-hmm.
So we go back to page 15, there's maybe page 14, there's numerous largest detractors to your income fund.
Mm-hmm.
And then fast forward to 16, a lot of the same companies there that are the largest changes in your exposure. I think that would actually be 17 if you look at 12 months. A lot of these are big companies that are very well known to us and independent investors. We've talked a lot recently about watch lists. What does your company do at Dodge & Cox about watching these and making those adjustments, even when they are very well-known investments in big companies?
So to the first part of that, the largest detractors, these names, these 5 names here, we call those out just because they're most significant detractors, but they each only detracted, say, 1 basis point or so, whereas the largest contributors added 15, 20. So we're trying to be as balanced as possible here, but the magnitude is much different. In terms of a watch list for securities, I mean, we're continually looking at securities. I mean, we don't, I think if there's some M&A rumors, you know, that would be something that we'd watch very closely. It doesn't go on a watch list per se, but our credit analysts and our global industry analysts are watching really every holding in the portfolio and kind of re-underwriting as earnings come out, as kind of news comes out, as the market shifts. So, you know, we want to make sure that fundamentals are appropriate, but then valuation too, and is kind of the intersection of those appropriate. So I hope that answered your question. If not, please let me know.
Yeah, I know on page 17, a lot of these large companies, it's a 12-month reflection of their performance. And I don't think anyone on this board wants you and your company to overreact. I just didn't know at what stage you guys become concerned with some of these exposures.
Right. And so on 17, the names that are shown there, these are trims. So it's active trims. This isn't a reflection of performance.
Okay.
But if a name is underperforming, that's definitely going to get our attention. And we have different kind of risk metrics to make sure that we're kind of looking at the overall risk of the portfolio and by sector. We have controls in place for that.
I guess I was making an assumption on 17 that the trims were related to performance in some way, that's why you were adjusting.
No, so these names actually performed really well. And so I guess it is related partly to performance, but we've reduced some of the names that have performed better than we expected or have exceeded what we think is appropriate based on fundamentals now.
Okay.
So
Yeah,
the
that's
risk
correct.
is skewing a little bit higher.
It's going the other way. So as the spreads tighten, that means price is going up. And so the fund is deciding to actively choose different bonds to get out of because the prices are higher than they would have otherwise been.
Understood.
Any other questions?
Well, just on 17, it looks like it's about a dozen or so bonds that you trimmed, and there's only 2 that are shown that were added to. So where did you rotate those funds into?
So if you look down to the bottom here, the summary of sector changes, it's pretty small, but you can see the sectors that we've kind of ramped up over the past 12 months. Mostly treasuries, a little bit within securitized, so agency MBS. That's largely where the proceeds of those trims have gone.
Okay, so
So
treasury,
kind of de-risking the portfolio in a way.
got it. So we know what treasuries are. So just can you define for us your definition of what you mean by securitized?
Sure. So securitized would be agency mortgage-backed securities and asset-backed. The vast majority of what's in that securitized sector is agency mortgage-backed securities.
And it's approaching half of the fund.
That's right. Yeah, definitely on the higher bound, but it's a reflection of kind of the overall richness of risk assets right now. Great. Well, thank you. Why don't I turn it over to Dustin?
Morning, everybody. I'm Paul. So I don't have to hunch over in my back. No, it's my parents' fault, really. I'm so dumb. Good morning, everybody. Hope everyone's doing well. Thanks for having us. Excited to be here. Beautiful up here, so I look for any excuse I can to come up this direction. So honestly, I don't have any agenda or something that I really want to get across to you today. I'm just here to be helpful. So we have some slides that go through sort of fundamentals of fixed income to educate the group on sort of how the market works and how we think about it. And then what my specialty is, or kind of what I focus on, is in the securitized bucket that we just talked about. So I can walk through sort of a case study and kind of look at what mortgage-backed securities are and get a little bit more detail in there. But honestly, feel free to ask questions throughout as much as you'd like. There's no dumb questions. Please let me know so that I don't, go too boring or too over people's head or anything like that. So hopefully we can get the right speed. But anyway, I'm Dustin Seeley, been with the firm for 8 years, another 5 or 6 years before that in the space. And along with Alex, I work in fixed income and have been in fixed income my whole career. So what I wanted to talk about today is the securitized piece specifically, and what we'll do is kind of start with fixed income broadly, and then kind of start zoomed out, and then zoom in as far as we want to. So first and foremost, what are the roles of fixed income? What are the get that you get from fixed income? And There's a few. I mean, you could make a very long list, but the core drivers of the role that fixed income plays in a portfolio, you could say, are diversification, first and foremost, relative to other assets. There's all kinds of other investments out there. Diversifying into something that behaves differently, meaning that when one zigs, the other zags, is often very productive for long-term returns. Stability of return, just meaning that fixed income generally has lower volatility. It doesn't move around as much as stocks or commodities or private equity or what have you. It tends to be quite liquid. These are publicly traded securities, especially treasuries and mortgages. And then, you know, the its namesake, I suppose, the income component of fixed income. It's throwing off cash every month or semi-annually or what have you, and then that cash can be reinvested. So there's a clear role that could play in someone's portfolio, either personally or institutionally. It's a big market. The market's a little over $50 trillion, almost half of that in US Treasuries, another big chunk in mortgage-backed securities. That's why those are the two most liquid asset classes. And then corporate bonds, munis, ABS, and all the way down. And then on the next slide, this just shows some volatility stats, just thinking about how markets move and when your investment, what kind of investment horizon you're using. Your volatility, of course, matters. You don't want to be in highly volatile assets if you have a fairly short time horizon, because you could need to extract the cash and use it at a time when it's not opportune. So having lower volatility is a core part of what fixed income adds to a portfolio. So here you can see fixed rate MBS and ABS, which are the two components that I focus on, are pretty far on the right, pretty low volatility, which makes sense. They're also relatively low risk, and they're also relatively low return compared to other bonds. And so the question is, well, why would you do that? Why not take the thing with the higher return? So on slide 6, it shows this idea of risk-adjusted returns. You always would want to say, well, of course, I want the biggest return. Give me the biggest. And so if you just look at the last 20-year track record of various asset classes, U.S. stocks have dominated, of course. And then if you look at total returns for MBS and ABS, they're, again, further to the right. But what's interesting, if the chart on the right, if you look at a Sharpe ratio, which is basically just a risk adjustment, so it's sort of the return you're getting as the ratio of the volatility in the asset. Well, now MBS kind of bumps up into being fairly close to what U.S. stocks are from risk adjusted. And so that's valuable. How valuable kind of depends on the environment, but there's value in obviously lower volatility. And then on slide 7, just wanted to focus real quick on what total return means. So we would call ourselves total return investors. We're not pegged to a benchmark. We're not trying to hug the benchmark. We're independent, bottom-up security selectors, and we are constantly focused on best total return. What are the best total return prospects for the future? And so when you think about total return, there's really two components in fixed income. There's the price change, which is obvious if it goes with you or against you. But then there's the income that the security is paying you. And over short periods of time, of course, price could move around a lot and impact your return. But as long-term investors like ourselves, really over longer and longer periods of time, the income tends to overwhelm the price change, because you have income and you get a coupon, take that coupon and you reinvest it. Well, now that coupon is earning a coupon, and that coupon is earning a coupon, and so forth. That's the power of compounding as it relates to fixed income. So this is sort of a bit of a silly chart just to kind of illustrate, like, if you were to stack up the coupons over a 10-year period as an example, that list starts to compound and get really huge to the point where you can't really see all of them listed. So it's just sort of a quick illustration to say, money makes money and the money makes money, I think Ben Franklin said. So it's this idea of compounding your income, compounding your coupons. And that's obviously something that, every time we get pay downs or coupons, then they're reinvested into the fund. Okay, so spread is, as Alex was talking about, OAS, there's Z-spread, there's OAS, there's interpolated spread to treasuries. You can go crazy with the technicalities of what each spread means, but the core idea of what a spread means is you've got some risk-free benchmark, which we're going to call U.S. Treasuries, and that benchmark has no spread because that's just sort of the risk-free benchmark. So anything that you're going to get paid above and beyond a Treasury yield or Treasury return, you're now taking more risk. You're taking additional risk just Treasury. And the total compensation that you're getting paid for that risk, we call a spread. So it's basically just the difference between the two yields of those two securities. And if I were to sort of summarize the risks that you can take in fixed income, or said another way, summarize the ways that you can make money in fixed income by taking those risks, it would be sort of these 5. Interest rate risk, which is depending on what your duration is and how far rates move during your investment horizon. Credit risk, of course, if a company defaults. Prepayment and extension risk, which is my world. That's what mortgages and some ABS have prepayment risk, which we'll talk about. Liquidity risk, of course. You could have something that performs really well, but if you can't sell it when you need to, that's a risk. You have to have a fire sale and not get the price that you want, and so liquidity comes at a cost. And then currency risk, of course. And we're talking about U.S. assets here, so not really relevant. But that's sort of what a spread is, and you can see the chart on the bottom right that kind of plots a handful of different spreads, in this case, option adjusted. Okay, so slide 9, I want to sort of build on this concept here that I think maybe some of you understand, but I think is often misunderstood even by fixed income people, sort of building up to convexity and negative convexity, which are kind of funny things. So first, we just want to start with the basics of what the price to yield relationship of a bond is. This is something that Robert mentioned earlier. If spread tightens, then the price goes up, and vice versa. So your yield and your price have sort of an inverse relationship. As your yield goes up, your price goes down, and vice versa. So it's just a simple chart to show that. And then to build on that on the next slide, now you have this concept that we call duration, meaning the duration is effectively the slope of this line. I wanted to visualize it. And so the duration is just telling you an estimate of how sensitive a bond is to changes in rates. If interest rates go up 500 basis points, how much does your bond decrease in price? And so the duration is an estimate of that. Obviously, the longer duration, more sensitive to interest rates. But it's not a linear, simple line like that in practice. In practice, these lines are typically curved. And because as rates change, the duration itself can change, which means the slope of that line can change, and it can change to sort of form this curve. So it forms this convex line, depending on the angle that you're looking at it. But that convex line, we call convexity, and to measure the convexity is just to get even better at estimating what risk you're taking. What would the price change be of a bond if rates were to move up or down? And so kind of knowing or understanding or guessing what that line is look like in rate change scenarios is a core part of what we do, is running simulations of various rate scenarios to know sort of what would happen and how much risk we're taking. And so because this line is curved, this is for non-callable bonds, then the duration is an estimate, but you have to sort of adjust it for this convexity, and now we can be more precise. So this is sort of, just the basics of how you would need to, the concepts you'd need to understand to make accurate assumptions on what you're investing in. Okay, so last but not least, to bring the chart home, or to try to illustrate and build on top of this sort of visual framework to make things even more complicated, when you have a line that looks convex, like we saw in the previous chart, you have a bond that is non-callable. But it can go the other way. You can have a line that sort of curves the other direction. So instead of convexity, you have what you would think would be called concavity, but that's not it. Of course, it's more complicated. They always make it that way. They call it negative convexity. So it's negatively convex, again, depending on the angle that you're looking at it. But the point of this is those two lines, let's say the convex line is a corporate bond or a treasury, and then the concave bond or negatively convex line is an agency mortgage. One is the reason that it's this way is because a mortgage is openly prepayable. Anybody that has a mortgage, you can walk into the bank or log in online and pay off your mortgage anytime you want, and in this country. And in order to estimate how many people are going to prepay and why, what their incentives and drivers to do that would be, what would consumer behavior of that borrower be, that's what we do. That's what our team does, is try to understand that and basically effectively measure this line, measure what that line looks like. And then when you have those two lines, then you can say, okay, well, in that sort of blue range in the middle, that's where MBS outperforms. And so what happens is you basically have a zone. You have that blue zone, and that's the happy place where you outperform the alternative. In this case, let's say it's a corporate bond or treasury. If you stay within that zone of rate range over the investment horizon, then the MBS outperforms and you have excess returns and everyone's happy. If it goes outside of that range, meaning too far to the right or too far to the left, you have these scary brown zones, which is prepayment risk. We can call them different things, prepayment on one side, extension on the other side. But it's basically saying the prepayments, the amount of people that are refinancing their mortgage, repaying their mortgage, is in those zones either faster than we want it to be or slower than we want it to be. And both of those are bad depending on the price, the period that we're in. Right now, for instance, everything's at a discount. After rates rose by a lot, you have discount bonds. And so you're worried more about the right side, extension of that scenario. Okay, so that's my attempt at describing negative convexity, which is elusive to most people. And if it went way over your head or it doesn't make any sense, please let me know and see how I can better describe it. But this is sort of the core, the crux, the risk that you take in the agency mortgage space. Since agency mortgages are backed explicitly or implicitly by Fannie, Freddie, and Ginnie, then you're not taking credit risk. They're incredibly liquid, second most liquid sector in the country, in the world probably. And so there's not really any risk there. Yeah, go ahead, Robert.
So Dustin, I have a question about this MBS outperforms kind of yield range. Is there sort of a typical range for different products, or is that range very large? I know this is just an illustration here.
Right. Yeah, the illustration, I'm curious to look over history and see how accurate the illustration is in terms of how big that zone is. But the short answer is it's always changing. And later on, there's a chart in the very back where the backdrop that drives all of this, which ultimately is interest rates, the biggest driver, how much incentive you have to repay, but also where the other line is. So it's not just the shape of the MBS curve, it's also where the other curve is. So you're always looking at total return prospects relative to something else, treasuries, corporate, community, ABS. And so the other line, depending on where it's sitting, of course, the zone could get more smaller. And right now is a great example where that zone is pretty big, it's pretty wide. The range of outcomes where MBS broadly outperform alternative assets such as credit or treasuries is pretty big, pretty wide, which is sort of circling back to what Alex was talking about, why we are so overweight in securitized products right now. And then in other times that zone is small, and during those times that's when we would lean out of something like securitized because the range of outcomes, it doesn't look as promising. If that makes sense. If you have 10 scenarios and 9 of them in the future are really great outperformance, then that's a pretty good ratio to be simplistic. And if it's 1 out of 10 scenarios, then that's not a very good bet. So that's hopefully that's helpful. But it's constantly changing, and part of what we do as a firm and in our department is constantly communicating with each of the teams. You have corporate bonds and ABS and treasuries and mortgages, and we're always talking about relative value. How does your product look over here? What's interesting over there? What type of total returns can you expect over here? and then let's run them all and compare them together. Then that allows us to lean in or out where we're finding. Okay, so that's bonds and so the key concept of negative convexity, which is important because sometimes you could think, well, why invest in something that has relatively low yield compared to something like corporate bond stocks. And agency mortgages in particular, they serve a role. They play a role in the portfolio. They're not, we're not trying to hit home runs with agency mortgages. We're batting singles and doubles, having solid performance and with liquidity, so that we can use that as a source of funds when we're really finding cheap value, especially in the corporate space. Okay, so let's dive into structured products for a minute. The sort of zooming a little bit deeper into the fixed income world, this is just structured products or securitized products, synonymous. Anything that is securitized is basically a pool of loans, whether those loans are auto loans or home loans, of course, mortgage, or credit cards, commercial real estate, multifamily loans, whatever. Anything that is sort of compiled into a bond and sliced and diced and packaged, that's a securitized product, and it's dominated by the agency mortgage space. But we also have a not insignificant position in ABS, particularly student loans. Those are federally backed student loans that are structured into bonds, and those are a part of our portfolio to the tune of around 5%. On the next page, I won't go through all of the details here unless anybody wants me to or has any specific questions, but this is kind of a snapshot of a few of the products that are sort of core building blocks of our structured products portfolio and what they do and what they mean. Obviously, the mortgage space is self-evident. Everyone knows what the mortgage market is, and these are bonds backed by U.S. consumer mortgages. FFELP-ABS is the federal loan program I mentioned. HECMs are actually reverse mortgages that you might see Tom Selleck commercials for seniors that get the opposite of a forward mortgage. They get the reverse mortgage where they get paid. And then hybrid ARMs is a different type of mortgage, and multifamily IOs I won't get into. But this different players in the portfolio that do different things. And we've built a portfolio that we feel is durable across sort of that range of interest rate outcomes and relative value to other products. So you kind of build a portfolio bond by bond, thinking about total return outcomes in that way. Next slide is diversification. We already talked about that with fixed income broadly. Within securitized products or within our portfolio, the diversification relative to corporate performance is really important, because let's say over the past from the wides of about 2022, they've had pretty massive tightening in the corporate market. And so that tightening has been absolutely large. So, the line going down, spreads tightening means prices are going up. As those prices go up, they get to a point where we're sort of, less comfortable owning them at those high prices. And so we've been trimming, if anything. We talked about with Quincy earlier, the names that we were trimming because the valuations went up by a lot, and we're trimming that cash. And instead of putting that into more risk where we feel like prices are relatively high, we're putting that into safer assets, treasury, agency mortgages, getting a singles and a doubles while we wait for the opportunity to sort of hit a home run and buy some really high quality corporate bonds, which is sort of the leaning in and leaning out that I mentioned. But with the spread tightening and the price appreciation in the corporate market, the slide on the right shows relative to the mortgage market and ABS, it really sticks out as being cheap, meaning this line going down means that corporate bonds relative to ABS and mortgages look relatively expensive, relatively cheap when you lean out of one into the other. What we're talking about. And in historical returns, this is more of the same. Standard deviation is how much risk are you taking, what kind of excess returns you get over history. MBS don't stand out here as particularly compelling and exciting because as you noticed from the negative convexity chart, that zone of outperformance, if you have very high rate volatility in either direction, then mortgages don't do well. So if you're going into a period or if you expect the interest rate regime of a country to be incredibly volatile all over the place going forward, mortgages are generally not a good idea. And so, of course, part of our thesis is that it won't be that extreme constantly, persistently going forward, and that mortgages have an important role to play in the portfolio. Why don't I stop there for a second? We can get like deep into mortgages. I have a couple slides here that give some examples, but I don't want to lose people. Is everybody, how's everybody doing? Everyone have, yeah, go ahead, Robert.
So and I just want to mention for the board, the fund broadly as a whole, looking at slide 16, depending on the period you're looking at, the standard deviation of the fund as a whole is somewhere around 6. High 5s, maybe 6.2, depending on what period you're looking at. So that just to kind of give you an idea of these structured products being 20, 30, 40% less volatile than the fund.
Great, thanks. All right, any questions so far? Are we good to keep going? By the way, how much time do we have? I don't want to take anyone's time.
I think you're good.
All right, I will keep going. Okay, I'll give you a few. We'll do a shallow dive into mortgages, and then stop there. But slide 17 shows sort of all of the risks in fixed income. All of it. It highlights some of the key risks that we take in fixed income. Some of the ones that I talked about earlier: credit risk, prepayment risk, liquidity, structure, and so forth. Within mortgages in particular, again, we're not taking credit risk per se, but it's really about prepayment. When will mortgages be prepaid and how much? And sort of estimating that is a bit amorphous. It's not really binary, where either the company defaults or it doesn't default. It's, there's going to be prepayments. People prepay their mortgages all the time, but the question is what will those numbers look like on a scale of 0 to 100? And so that's really where we focus our time. And so the way that we do that, on slide 18, trying to think about like, okay, well, what is the U.S. mortgage, the consumer, the U.S. consumer that owns a mortgage, what does that borrower profile look like? Who is this person? What bank did they get it from? Or what non-bank did they get a mortgage from? What are all of the factors that could influence somebody to go and finance that mortgage? So it's very, I think everyone should be familiar with these, with that feeling, I suppose, of when it makes sense to refinance. It doesn't. And hopefully anybody that has a mortgage took the opportunity to do that with a 2.5% or 3% or 3.5% mortgage, and sort of what the whole country is locked into now. And now that nobody wants to move because they've got a 3% mortgage and the prevailing rate is 7%. And so it's just way too expensive to move. So instead of getting divorced, you just, bunk up in the garage and figure it out because it's a lot cheaper. And so you have a situation now where everybody, the whole country for the most part, is negatively incented. They have negative incentive to refinance. It would cost a lot more money to get a new mortgage, and so they don't. And that means that prepayments are really, really low. And so what that means from an analysis standpoint is, okay, how slow could they get? Because there's always people moving, and people die, and people get divorced, and people move for jobs, and there are reasons to move that are non-economic, but they are, it's a relatively low number, we're talking 3, 4, 5 annually. And so our analysis, we use various ways to sort of predict what a bond will pay, how it will perform in the future. So at the borrower level, we're looking at the borrower, what does their credit look like? How much equity do they have in their home? Where do they live? We look at disaster risk. We look at what are the loan characteristics, the actual loan, what kind of rate are they paying, how much balance is it? If it's a massive balance, then any tiny incentive is going to be, taken advantage of. If it's a really small loan, then they might not, if you have a $50,000 loan, you might not take the trouble to go through the hassle of refinancing your mortgage and paying $5,000 to get that done when that's 10% of your outstanding loan. That doesn't make sense. But if you have $1 million loan, then it's easy. So those dynamics play a role in we are doing security selection, trying to pick through all of the bonds in the world and find the ones that are, in the opinion, the best or have the highest probability of outperforming over time. And then there's external factors, governments, programs, different servicers that are more aggressive. If you have Rocket Mortgage, they're going to call you 20 times on a robo-dial. If you have sort of local credit union bank, not so much. So these all matter when it comes to analyzing bonds and trying to security select and outperform. Yeah.
Yeah, so something that stood out to me here was the servicer, and I wasn't really sure, what does that mean, an efficient servicer?
Yeah.
I mean,
Great
I
question.
always get, right, my statements.
Right.
What exactly is that?
That's a great question. So
Exactly.
it is. So you've seen like a Rocket Mortgage commercial on like the Super Bowl, right? Quicken Loans, they're big. What we would say in the efficient category of servicers. And efficient in this context isn't necessarily about how they manage your loan and statements and so forth, which is a great point. I think we should probably update this bullet to be more descriptive. Efficient in this case means how efficient are they at refinancing your mortgage if you're incentivized to do so. So if your mortgage is 5% and then the prevailing mortgage rate is 5%, then no one should call you because there's no reason for you to do anything. But if rates move down to 4.75, then there are some servicers that just don't have the staff and the salespeople to do anything about it. They don't call you, they don't email you, they don't say anything. It's kind of up to you to be on top of it and say, oh, hey, I can save some money by refinancing. Why don't I go ahead and take the action to do that? So that would be an inefficient servicer, someone who doesn't call you and reach out to you. Whereas, if it drops to 4.75, you're probably going to get a Rocket mortgage call and email and text and, call your mother-in-law and anybody to try to refinance that because they have a different business model and they want you to refinance. If you have even the tiny bit of incentive. And so if you had a bond, for instance, that is backed by 100%, not to pick on the mortgage, their behavior is different over time. So if Rocket Mortgage people, this is not a slight, it's more that if you had a premium bond and you don't want fast prepayment, and you had two different servicers, Servicer A and Servicer B, and you know that Servicer A has a behavior in the past of being very efficient and ending up with faster prepayment speeds, well, you wouldn't want that. And so you'd pick bond B, all else equal, or Servicer B, all else equal. But there might be a price for that because mortgage is dumb, and so they're going to price accordingly. And so then it's a question of, do you agree with that price? And then if you're in a discount environment, then it's the opposite. You want them to have. So that's what efficient is in this context, which now that I explained that, not very descriptive. So thank you.
No, thank you.
Yeah. So the point is there's a lot of stuff that goes into analyzing these. The next slide, we don't need to get into this, but there's some more sort of stories or, components or characteristics of a bond. You could pick apart and dissect, every tiny detail all the way down to the loan level of a borrower. And then there's 100,000 borrowers wrapped into one pool, and then that pool is added to a pool of 100 other loans. It's a whole project. That's why we do what we do, to try to identify and security select bonds every day. And this is what our desk does. We're just constantly talking about, hey, look at this bond, look at this bond. What do you think about this? And we pick it apart, and it has this percentage of that and that. I think this is probably going to outperform, and it's priced attractively. That's a good bond that we can buy for the portfolio. We'll have a total return that we think will be additive to outperformance. So I won't go through all the details, but the point is there's a lot of different features of these securities that you can analyze, and so it lends itself well to security selection on an individual CUSIP by CUSIP level, which is team does every day. Okay, so the strategy slide, I think you can read that one later. The point of this one is to outline kind of the way that we look at the world, which is incremental yield, high credit quality, strong liquidity, intermediate part of the curve. That's sort of our wheelhouse, singles and doubles, like I was mentioning. And then, we focus on agency guaranteed bonds, and these are the reasons why. So slide 21, I'll finish with this, which is to say that things change all the time. And that's sort of the fundamental premise of an active manager versus passive manager, right? Is can an active manager adapt and change over time? Can someone outperform during one period of time where, yields are just ripping lower and lower for 20 or 30 years, and somebody, does really well? It's like, okay, sure. How about in an uprate environment or a different environment or whatever? And so the strategy continually has to evolve, and that's sort of the premise of an active manager. And then the proof is in the pudding of whether they can do that over various different time periods, different states of the world. And so this kind of outlines a handful of different states of the world where, the 90s was a very specific time and different type of borrower behavior. Then there was this bank era where banks were very involved, the credit crisis, of course, from 07 on, normalizing after that and getting back to a state of the world or figuring out what the state of the world will look like post-GFC, and then, of course, the pandemic era. So the world is always throwing wrenches in the machine, and always a question of how can we adapt and pivot and lean in and lean out when and where we're supposed to, which is what our job is. But as you can tell, our portfolio composition has changed quite a bit during that time, but we've always maintained a relatively high percentage of the fund in securitized products in some form or fashion, because singles and doubles is really what you want in all states of the world. And if we can do that in a cost-effective way, meaning outperform after fees in just our component of the portfolio and at the whole portfolio, then of course we've earned our keep. If not, then not so much. And so that strategy has changed quite a bit, and right now is an interesting time for mortgages, which is I think why I'm here talking about it, because we find them to be relatively attractive and to justify the fairly high weight that we have in the portfolio. Yeah, I think that's a pretty good way to stop and wrap it up. Happy to answer any questions. Hopefully I didn't put anyone to sleep. Everyone got their coffee and good.
I do have one question.
Great, Doris.
For the student loans that were listed as asset-backed, is that simply because they're federally guaranteed? Because they don't typically have like a home or a car that's considered, backing a traditional collateralized loan. So I just wondered why they were considered
Asset-backed.
Yeah.
Right. Yeah, because it's not a physical asset; it's an imaginary asset, effectively, or it's an unsecured asset, if that's better. Yes. So yeah, asset-backed is a pretty inclusive name. We're all about inclusion. And so asset-backed is anything really that is a consumer loan or pseudo loan, something that behaves something like a loan, that you can compile a whole bunch of them together, get large numbers of a bond, and sell it. So a similar example would be a credit card. Credit card, I guess, is a physical asset, but it's not like a loan. Go and sign documents, term. But in effect, it's sort of a monthly that you're just kind of constantly paying off or maintaining. And so you can take that as a receivable, effectively. That's an asset. You can take that and securitize. And so a student loan is a loan. It's an obligation. There's nothing you can repossess. You can't go and if they default, you take their student loan away from them because there's no physical asset. So it's effectively unsecured, but it behaves differently in the sense that it's a consumer unsecured loan, but is ultimately guaranteed by the government, and so it's a little bit funky in that way, and that's part of what we like about it. If you get your hands around the funkiness and public policy risk and understand that, they're great bonds and perform really well for us. Great question.
Thank
You can securitize anything is the short answer. There's a famous David Bowie album that were securitized, shipping containers. Pretty much anything you can think of, someone's tried to securitize it. Good question. Yeah.
So on page 27 of the other report, so maybe, I don't know if you're equipped to answer it.
Do my best.
It goes to the fees for Dodge and Cox and for institutional investors.
Mm-hmm.
So I don't know if you have it memorized or look it up.
I don't, but I'll look at it. One second.
So, on page 27, it appears to say that for intermediate fixed income, which I would think is our Dodge and Cox income fund. Is that,
So, income fund, yes, income fund is considered discretionary. Intermediate, fixed, and there are different definitions based on this page here. Income fund, discretionary core.
so what is our fee for this fund?
So that's actually on slide 26. So the class I income fund, 41 basically.
Okay. So what is the discretionary core referring to? If we had more money in the fund and we had 150 million, would we get the lower rate?
So those are for separately managed accounts. And we have an account minimum 50 million. So the overall fees would be.
So our two bond funds or fixed income funds together are right up around 140 million. So we're approaching, again, if we were to consolidate, we would appear to get a lower fee.
That's right. There are other associated with opening a separate account. Probably something for your consultant, bank custodian, for example. So it's more inclusive than just.
And then the other is, so the Dodge and Cox fund, as I understand it, it has the ticker DODIX and 41 basis points. But the same fund, but with a different ticker, has been offered since 2022 at 33 basis points, so savings of 8 basis points. And but my understanding from Morningstar is it's been offered since 2022 to maybe some 401k employees as a maybe marketing to get some 401k customers to come in and pick Dodge and Cox.
It's less about kind of trying to attract assets there. It's the reason it's lower is that there are certain costs associated with managing all sub accounts and providing statements to all these 401k investors. We don't do that business ourselves, so you have a record keep that this is meant to offset the costs of servicing thousands of 401k participants.
I guess what I'm trying to figure out is if an individual investor who invests a minimum of $2,500 can get a 41 basis point fee to enter into this fund, why should MSARA with $70 million in this fund still be paying 41 basis point? Why shouldn't we have the ability to get a lower fee than the average consumer off the street who's investing as little as $4,000 or $5,000?
It's a good question. It's a flat fee though. So that I think that is an opportunity where a separate account could be advantageous. But we don't have, for our mutual funds, we don't have different tiers.
Except through this process you said on page 27.
But then that's a different vehicle, yes, except for a separate account. That is a different schedule.
Because I've noticed, Vanguard and other companies will offer institutional investors who exceed a threshold. Sometimes it's 5 million, sometimes it's 50 million. Institutional investors above a certain point will get a discounted fee because it's a huge basket of funds for the fund manager to manage, and there's economy of scale there.
Right. That is something we see in the industry. We have typically only had one share class. Now we have their share class for these 401k participants. We don't have multiple share classes based kind of an institute.
So who would it from MSARA approach Dodge and Cox and say, hey, we like your fund, but we don't like your fee?
You can certainly, message received. I'll share that. Yeah, there isn't at this point a fund that would be lower.
And so let me jump in on this. Just to clarify, these are separately managed accounts, and so there's a different ownership structure fundamentally between the two. Ownership or interest in a mutual fund, where the mutual fund is owning the securities, versus a separately managed account where we would have ownership rights of the individual. So there's a number of different benefits to doing that. And I can't speak to traditionally years ago what the discussion was and why we have never gone to a separately managed. But that's a choice that hasn't been made. But like Alex mentioned, there's additional costs. This is not the only cost. There are trading costs, there's administrative costs at the custodian, there's additional other costs. So if we were only concerned about the expenses, we would need to do an additional analysis to hone in on what that actually would be.
Or alternately, and Sarah and maybe Callan would meet with Dodge and Cox and say, hey, can you break loose an institutional rate?
We can certainly try that. I think the reality of that's pretty low. Even if we were to put $140 million into what, a $68 billion fund, I mean, we're not really, we don't have very much weight behind our punches, you know. We certainly could try.
Great. Well,
Thanks,
thank you
everybody.
for the questions. Yeah, appreciate it. Thanks for your time.
Yeah, thanks for having us in.
Thank you.
Take care.
Have a good one.
Thank you. Yeah.
So I think we're moving on to the next item,
Okay.
correct?
Is there any, are we moving on to your portion of this, or are we moving on to agenda item 3?
Oh, no,
Item
let's-
2C.
Yeah, let's go through infrastructure update here. And it looks like Judy's got the slide up. Briefly, my memo sort of walks through one perspective on the infrastructure outlook that we can expect over the next maybe 5 to 10 years. And that's broadly characterized by spending in the U.S. On infrastructure projects specifically, and green products, green energy products transition broadly throughout the world. So I won't necessarily go through the memo on that, but suffice it to say that there should be a supportive environment over the next decade for infrastructure investors broadly. I also went into detail about some of the sectors that we are going to look at here in this presentation. So if we can go to the next slide here, the IFM fund, Global Investment Fund. Here we can see the geographies. We're able to move to the next slide. There we go. And we can see the IFM exposure. A large portion of the fund, a little over half, a little under half, excuse me, about 40% of the fund is in the US and Canada. And the remaining regions are in the UK, Europe, Australia, and Mexico. I would note here that the other region is the Bahamas and Turkey and Chile. And we can see that they're fairly stable. In the last few quarters over the past year, the Mexico exposure has increased. The reason for that is that the fund has bought more interest in the Aliatica investment, and that is a toll road operator in Mexico. We can move on to the next slide here, being the JP Morgan Infrastructure Investment Fund. And here we see quite a bit more of changes by geography. And there's really two reasons for that. The first reason would be in early 22, we can see that the European region sort of bumped up from what was about 35% of the fund exposure. and that bumped up to a little, maybe about 45-ish% exposure there. And that change in geography there is primarily a result of acquiring a company, GE Tech. They are a German, and I do mention them specifically in the memo as well. They're a German energy company, and they have their fingers in a lot of different parts of the German green industry. And so you can see that bump up. And for about 3/4, that exposure stays roughly the same until it actually, we see an increase in the U.S. Now, it is important to note that they didn't necessarily sell a bunch of these assets, but this sort of gives you an indication of the size of the assets, which are extremely large. And what happened in 2021 here to boost the U.S.-Canada exposure to about 50% of the fund was purchase of South Jersey Industries. They are a New Jersey-based utility. And so they're about 13.5% of the fund. They are the largest asset. We go to the next slide here and look at the sectors. In the memo, I explain a little bit about what these sectors are. And as this is sort of the first update that we've done here, there's a little bit of judgment call in what sectors I'm calling what. And I sort of do mention that in the memo here too. These are the sectors that IFM would report in their reports if you were to look at them. They've got seaports, toll roads, airports, midstream companies, utility companies, digital infrastructure, and renewable exposure. Seaports, that's where goods come in from other parts of the world into the U.S. Or Europe in this case. Toll roads are just roads that folks drive on, heavy equipment moving around. Airports, most of us have been on an airplane. We know what those are. The midstream is characterized by a few different sub-industries. And in this case, midstream here is all of them. So that would include energy storage and transport fuel systems, pipelines, and distribution centers. Utilities would be including electric and water utility systems. Digital infrastructure includes fiber networks and data centers. In terms of the renewables exposure, those are your old-fashioned renewables, things like wind farms, solar farms. And then also renewable natural gas, which is like methane, biogas coming from different sorts of waste. We've moved to the next slide here. We can see the sectors for the JP Morgan Fund. Probably the biggest difference that stands out to me is just the renewables exposure here. Now, again, there's sort of an issue with how these funds are reporting what subsectors, and I do sort of mention that in the memo as well. Here, I've chosen to include natural gas utilities with district heating as a separate sector, instead of sort of lumping that into a broad utilities sector. The utilities sector on this slide is just electric and water systems. Rail, we understand that's railway leasing, and so on this slide we've split up energy storage and midstream. Energy storage being terminals where fuels are actually stored, and midstream being pipelines and distribution systems for fuel, specifically fuel. Energy storage could include liquids that are involved in food processing. So they're not just fuels that would be used, natural gas or something else like that. They could include and do include olive oil, for instance. And if we move to the final slide here, this sort of gives you a higher level view of the number of investments and how the fund has grown. Both the funds have grown over time since MSERA's investment in them. The number of investments slide, not much has changed. The two strategies sort of have a different approach to acquiring assets. I mentioned that in the memo as well, that the JP Morgan strategy is looking specifically for companies that they can own in high ownership, that they control 100% or 90+%. The IFM strategy out of Australia, they've got a lot of connections with other Australian funds. The infrastructure asset class actually started really to develop in Australia. And so they've got connections where they tend to go in jointly into assets. So they've got maybe 40, 50, 30% ownership rights of all of their assets. But you can see that they've sort of increased a little bit, but not too much in terms of the number of investments. The net asset value has increased dramatically for both of the funds, and that's just a function of the popularity of the asset class. A lot of new investors are getting into infrastructure. It's sort of the new kid on the block in terms of the alternative world. And so we can see that the funds have grown substantially, almost doubled. JP Morgan fund has doubled, and the IFM strategy has not quite doubled, but it's getting close. On the leverage slide, you can see that they're relatively stable, although the JP Morgan leverage has come down. Now, this is the typical leverage ratio that we've seen with the real estate funds, where you're looking at net debt divided by assets in some sense. Now, the calculations are not exactly the same as the real estate funds, but they're extremely similar. Excuse me. It's essentially what is our debt level that we would be owing, and if we had to sell all these assets, what's the value of them in a fair market sense. And so while they appear high, I would note that they're not actually that high, and they are relatively lower. Now, they're higher than what we would expect out of our real estate funds, which we would like to see for real estate less than 35% in a core strategy. Here, they're quite a bit higher, 35%, 50-ish%, something like that. And that's really just a function of the type of assets that they're holding. These assets are not, they are not a $100 million building. These assets are 500, 600, a $1 billion asset, $10 billion assets in some cases. So the amount of cash that's required to operate them and maintain them on an ongoing basis means that these leverage ratios are much higher than what we would typically see in the real estate market. As far as the difference between the two ratios, about 35% to 50%, that's really coming down to the composition of the assets themselves. So JP Morgan has a higher percentage of contracted and regulated assets, and those require more maintenance. They require more funding. There are different regulators that require certain things of these businesses, and so they essentially have these higher leverage ratios. IFM has about half of the fund in cyclically GDP sensitive assets that require less upkeep, less volume. They're lower debt type assets. So that's the explanation for the difference between those. If you were to go look at PG&E, something like PG&E, you're looking at 67% debt ratios. So Utility companies are extremely high on that scale, 50% or more. Ports, 20 to 30%. Midstream assets, 30 to 50%. On the final slide here, we've got additional metrics that I thought would be helpful. I'd love to know if the board is interested in seeing other numbers here, but I show the net asset value, the leverage ratios, and I've also calculated through the March quarter the fiscal year-to-date return, the inception net returns, and the average annualized net returns for both the funds and the composite. The trailing 12-month distribution yield, the annualized standard deviation, and the correlation with the S&P 500. Things that stand out to me here would be IFM's performance. Fiscal year to date is a fair amount below what the 2F performance is. And we're going to see that just a few days ago. I got updated numbers for the fund. So we're going to see that continuation. We're going to see that IFM, they came in about 3.25% fiscal year to date. I haven't gotten JP Morgan's yet. But the primary reason for that underperformance is 2 quarters of lower performing returns in 2 assets essentially over both of those periods. In the third quarter, trustees may have noticed that IFM had a negative return of 1.1%, and that last quarter. And the reason for that, in large part, was because one of the largest assets in the strategy, Naturgy, a European natural gas company, was delisted from the MSCI global indexes, right? And so because they were delisted from that, from the exchanges, I guess, from those indexes, I'm misspeaking, I'm sorry. Because they were delisted from those indexes, those broad market indexes, that caused the share, the interest in the company, the publicly available interest in the company to decline significantly. And that's sort of been happening for this particular asset over the past year, continually. Specifically, the free float adjusted market cap share count for the fund or for the asset went below 15%. So that's the reason why it was delisted. Some of the other assets had unfavorable currency impacts. So even though the strategy hedges, it is still subject to these currency fluctuations. It's just not as much as would have been otherwise. So these losses for some of those quarters, those 2 quarters in specific, were still losses. The U.S. dollar has been quite strong, and these other currencies, the Australian dollar, the Polish, whatever it's called, I can't remember the Polish currency. There's a Polish currency in there. And the peso have all sort of devalued versus the dollar, while the dollar's gotten stronger. So this has created a large currency impact on IFM in 2 quarters. Finally, I guess I would point out the distribution yield. IFM is significantly lower. That's not a specific point that they make in their strategy when they came in and talked to us. That wasn't something that they focused on, whereas JP Morgan definitely makes that a focus of their strategy, and they're very purposeful about that. And we can see the difference between those 2 numbers, less than 1% from one and a little over 5% for the JP Morgan strategy. comment, questions?
So I think this slide is really informative, so thank you, Robert, for preparing that. I think what I look at is the very low correlation for both funds to the S&P 500, which I know is sort of a proxy for the total U.S. stock market. And increasingly, it's a correlation for the international stock market, maybe not in total performance, but the international stock market's not performing as well as the U.S. in the last 15 years, but they tend to go up and down more or less at the same times. So I think the fact that these both have very little correlation with public equities, I would say in general, I think is pretty telling for us. And the other piece I think is interesting is I'm looking at the composite annualized return, 8.9, basically 9%. Even if you put a conservative tilt on that and said, okay, some disaster occurs in some future event that can't be foreseen, a terminal's attacked by terrorists or something, you're still looking at maybe 6% annualized return over a long period of time, even if you want to, or 7. I mean, even if you discount that 9% in a forward-looking, and I'm not saying there's a reason to say that's going to happen, but I'm just saying if you want to be conservative about it. So I look at this as like, why can't we have more of this? I mean, if our fund had a higher allocation to these funds, we would be beating our target, and with almost no standard deviation. I mean, it's amazing. The standard deviation is less than 2. I mean, it kind of like real estate. I mean, very little. It's sort of a lag in when they report, and it's self-reporting, maybe outside audits. I realize it's not the same thing as a publicly traded equity, but it's, it's like, what's not to like about these funds?
Well, so, the listed infrastructure funds, just for reference, those standard deviations are maybe 10% probably, somewhere around there, 10 or 11%, depending on, again, what period you're looking at. This is only for the period we've been invested, one, so it's a very short time period in a very favorable environment for infrastructure, 2. And additionally, these are annualized from quarterly data, so there's a downward bias on the number that they still are what they are, and they are extremely low. I mean, it's the new kid on the block, and it looks really good right now in a really a positive environment for it.
I know we made what was it, 6% of our fund, and I think most of us considered that dipping our toe in the water to check the temperature, and it seems like a lot of other investments came in around the same time that pushed this particular the infrastructure to have these returns. But I think I remember it being quite illiquid, and it took a while to pull some of the funding to invest it, and then it is quite illiquid throughout our investment in this, is it not?
It's the same sort of thing as real estate, and actually it's even worse. I wouldn't say worse, but on the real estate funds, we're basically looking at quarters. On the infrastructure funds, we're really looking at half years periods. So
I'm not dismissing the opportunity that we could invest more. I'm just saying we can't get overweight in that type of illiquid investment and then question later when we need that liquidity.
Yeah, well, right now we primarily use equities as our main liquidity bucket. The S&P 500 fund has been on a tear, right? AI, large cap US has just kind of destroyed the market over the last years in a positive way, and that's the bucket that we have to continually peel back to sort of maintain our ranges. Additionally, I guess I would note, even though we're about 1.7%, I want to say, over the allocation, which is still well within our target ranges here. But we did fund an additional $12 million about a year ago into infrastructure, just because the entire portfolio sort of went up in value. So we had to put some more funds in there, and we did do that. you know, so it's worked out. I mean, it was great timing. I don't know that we knew that at the time, but it was a good time to do it. So we should credit Callan in that sense for that. Yeah.
It's genuinely done what we wanted it to do and then some. And the fact that we're talking about why didn't we do more is because it's doing well, which is, you know, we don't get patted on the back hardly ever, but it was a good decision.
So some questions I have, just sort of looking back and looking forward, is what's interesting as I feel like I understand more about what these funds are. I mean, you know, I remember seeing the presentations when they came forward and since, but I think over time, probably for all of us, we're getting a better picture on what these funds really, how they perform and what they do. But, you know, when I see a yield on the JP Morgan of 5%, I mean, that's what we're talking about for our bonds. I don't know if they're promising a yield of 5% going forward, but it's looking a lot like a bond fund in terms of yield, just from the JP Morgan. As you point out, the Australian company or entity is around 1, but the collective is almost 3, which is kind of what you would get out of dividends from a European or global non-US index fund. You know, US stocks used to give dividends of around 3, 4, 5%. Now they're down on average to about 1.3. International is still hovering around 3. Collectively, these two are around 3, but they're not dividends, they're yield. But it kind of sort of the same thing. And as I've pointed out before, if we have so much cash flow coming into this fund now from the employer and from the employees, that the amount of money needed out of the fund each year since, is it 2018, 2019, has only been about $8 million a year. And so, you know, when you're looking at dividends or yields of around 3%, you can achieve that $8 million a year out of a fund of $700 million. So when I see a yield from JP Morgan of 5%, and, you know, we don't have to sell our investment in there. We just have to turn on the, we could, if we needed that yield to make payments out, we could just not reinvest the 5% yield.
And we are doing that right now. So we're slightly overweight. The real assets there was a time when the real assets were almost 3% overweight, and we stopped the reinvestments in both the real estate and infrastructure to sort of back that down a little bit. We're still receiving the income from both of these funds.
And so I'm just putting out there that could be a strategy with these funds, is almost like on permanency. We're not reinvesting the funds necessarily if we want that, if the plan wanted that cash flow. The other thought I have is, what's interesting is we see that neither of these funds have more than half of their assets in the U.S. I believe we more or less took these funds out of a combination of our U.S. or international equities and our bonds. I think it's the 3 sources that we use to fund the 6% allocation. So our fixed income, I believe, is 95% or so U.S. Our equities are 60% U.S., 40% international. So we actually have, through this, I know it's a relatively small share of our portfolio, but we did, at least with this 6% allocation, we've actually increased our allocation to international investments ever so slightly, because it's over half between the two funds in international. And we had less than, you know, we had almost 100% of our fixed income in U.S. We had 60% of our equities in U.S. So I guess I'm putting it out there once again, because I see no evidence that international, on a sustained basis, equities are going to ever, in the foreseeable future, equal U.S. Putting it out there, state of Nevada, 70% U.S., 30% international equities. We are still 60% U.S., 40% international. And with funds like this, we're actually overweighting international, underweighting U.S. Maybe this is the better way to get international investment exposure, is not through international stocks, but through funds like this, and then dial back our international equity investment so that we can take advantage of the higher performing, lower cost US stocks.
Well, these strategies are sort of hybrids between the equity and the fixed income. As you're pointing out, the distributions are sort of fixed income-like. The nature of the valuation and the size of the assets being so large sort of minimizes the number of players that can be involved in the space, right? The numbers are so huge that they don't move around a lot because the transactions aren't happening all the time or every day like on a public stock market. So these funds are sort of attempting to get a best of both worlds, right? But I would say there is going to be a time when these funds don't look as great as they do today. That day will come in the future, and we don't really know when that's going to be. And that's not a reason not to dip in or consider, pushing our allocation up a little bit. We've got a 5% range that we can work in with our current asset allocation. So we don't necessarily have to change the asset allocation. We can just sort of lean in a little bit if we really wanted to. As far as that goes, there are the same caveats here that we have with the liquidity issues within real estate. There's queues. It takes time to move those funds around. So those are still things to consider, which we would want to consider at a different meeting. This is just an informational update.
Exactly.
Sorry, go ahead.
I mean, I'm just saying, when we look back, and we hope for a better future in the future, but when we look back at our last 10 years of our international investments, we earned 3.3%. I don't think there's any expectation that either of these funds are going to earn less, anywhere near that low range in a 10-year period. 3%, 4%. Anyway, the index of international equities earned full percent more than what our investment in international equities. We earned 3.3, the index earned 4.3. Both of them are in the cellar as far as I'm concerned for a 10-year period, given the fact that our target is 7% for our long-range returns, or 6.5. So, and certainly it should be more than 6.5 or 7 for equities. So anyway, I just feel like the international exposure that we get with the infrastructure funds is a rationale for considering dialing back our international equities, because we're getting international exposure in a big way with these infrastructure funds, with, I would say, lower volatility, higher expected long-term returns.
The only thing that I would add to that is these are very sector specific. They're not healthcare items, right? They're not these other sort of sectors that are out there. They're not specifically really technology. They're digital infrastructure, data centers, cable fiber lines. Those are supporting some of the new technologies and the things that we expect to be happening in the future with AI specifically. But they're just different things. They have different. They're different businesses in a sense.
The point I was going to ask you is, to be fair, when we switched from the adjustments from reinvesting in this class to not reinvesting because of the percentage of what we are invested in this class, that was intentional because you're trying to follow our asset allocation that this board voted on, and within the margins that we're allowed to operate. And what Dan is talking about would involve a more global conversation of changing that asset allocation that the board would vote on to then allow to operate outside those margins or set new targets.
Well, we wouldn't have to set new targets, but we could I'm not saying that we would do it, but without changing the asset allocation, we could just say, we're okay with it floating up to the top part of the range.
Right,
another
but that
1
was
or 2%.
not what Trustee Jurdy was suggesting, saying that our international equities allocation should be trimmed back. So you're correct, Trustee Cromer, that to have that conversation, it would have to be agendized for the board to consider a change in asset allocation again.
That was the point I was asking. Thank you.
So one was an interim step, the other one was a global conversation for another day.
Any other final questions, comments on infrastructure? Okay, let's move on to the monthly investment report. That pretty quick here. Judy gonna share that? We could talk about it just briefly. Of course, we pulled a little bit of cash, so I'm looking at page 2 of the Callan flash report. And about 1.3 million. We also actually had to use the income distribution from JP Morgan, which is not necessarily on this monthly report. That was about almost 400,000. So we pulled quite a bit more cash in the final month. We're going to talk about that as a point of interest in the cash flow presentation next for what that was. But on this second slide, you can see that we leaned a little bit more into the fixed income, putting $4 million into fixed income from the S&P 500 fund. So we did that twice. We did $4 million in the month of May. We did $4 million in the month of June. All positive purchases and get us to very close, within 50 or 60 basis points on each of the asset classes, if you include the real assets as a combination. So that was a good thing. Overall, we had almost 9.3% return on this report. It doesn't include the real estate returns, and it doesn't include JP Morgan here. I will tell you, based on new information, that the fiscal year return is probably going to be 9.34, 9.35% on a time-weighted basis. On an asset-weighted basis, it was a little bit under 8%, so that'll make Siegel happy. That'll make the plan sponsors happy. And Callan will be here with a nice year-end quarterly update next month, and that should make Greg happy. He's probably going to have a lot to say about what's been going on. But you know, broadly, things have been pretty good in the U.S. There's been no recession. CPI is ticking down. Unemployment remains low. Everything seems good. So. The returns for this year reflect that.
Just by putting, so we outperformed CalPERS, it sounds like, by 0.04%.
A little bit, and that's just my estimate based on what I know. So yeah, I think I saw them at 9.3.
Based on a press release, 9.3, and their fixed income was only 3.7, and we're at 4.3, something like that.
Yeah, and I'm not familiar what sort of, I would imagine they've got exotic fixed income products or strategies there. I'm not entirely sure. But we've benefited by having our managers be in the middle part of the curve, and the rally from the last 6 months, really starting in November of last year in fixed income, just carried through. It's actually carried through to to today, till last week. So the overall fund's somewhere around 35 million as of last week. So
it might be interesting to analyze it. I mean, from the press release anyway, according to my math, it looks like their public equities outperformed ours by a little bit, but our total portfolio outperformed theirs by a little bit.
Yeah, and as far as that goes, Callan can speak to more detail, but we've got that tilt to the smaller caps. And the AI run over the last year has really been focused on the large names, the largest names. 5 or 6 stocks over the last year have produced 30% of the S&P 500 return. So there's some concentration concerns on one hand, but the business and AI seems viable. And, how this whole thing plays out, we don't quite know. I would point out, just so trustees are aware, in the past week, there's been a massive rally in small and mid caps. Once the CPI numbers for June came out, that day things took off. Fixed income took off, and small and mid caps took off as well. So it's interesting to see those changes happen. That's it.
Okay, we have any other board member discussion on this? If not, is there any public comment? Thank you. Okay, going on to agenda item cash flow projection, 2020.
Judy, could you pull that up for us here? I thought the cat was cute. I figured, I'll just throw it on there, and hopefully everybody would like that too.
Oh.
It's a happy cat. I was happy when I was making this presentation. So we'll start on the second slide, and the board has seen this before. We've just incremented it by 2 more years. These numbers were projected. I would also point that this presentation was really made in the middle of June, so I wasn't sure exactly where we were going to end up with regard to our net position, the contributions. So it's got some estimates in it. But one thing that I would sort of point out here is that the blue line, has gotten closer to the top of the purple bar. And so that basically means that we have to pull less cash. The contributions are going up, and that's been through actuarial changes primarily over the past decade. But you can see that in 2014, there was a larger gap, and it kind of kicks up. You can sort of see the angle increase on certain years, and those are when we do the experience study. You can see that kind of every 3 years there's a kick up, and so now in the projections we at least see that those numbers are minimizing. So that's a good thing. On the next slide, we've just got the table format of the previous graph. So this is just a table of the same graph. Slide 4, if we go to slide 4, these are monthly benefits. We've seen them increase roughly at a rate of around 6% for the last decade. And so that's some of what you see here on the rate of increase. It's a lot of guesswork trying to estimate some of these numbers here. It's hard to say what we're going to see, but this is about a 6% increase in 2025 and a 3% increase in 2026. So it's actually kind of hard to see the difference, but there is a slight change in those numbers there. Can we go to the next slide? Here are monthly contributions that we expect. We can see that they've been pretty stable. There's a good funding policy that we've got with the county, and the courts are pretty good about sending us their funds these days. We do expect the contributions to increase about 11% in fiscal year 25 and 3% in 26. It's really difficult to tell what the county payroll is going to do. Now, every 2 weeks, I do an estimate of what I think the covered payroll is for all the covered tiers, probation, safety, and general, and I constantly update that each year. My guess estimate is that we're going to see a overall 3% increase in payroll for the county and a 2% payroll increase for the courts. The next slide, I believe administrative fees here. Again, these are projections. You can kind of see the increase that we've had over time. That's a function of payroll has been growing and projects have been growing and increasing. If it's not one project, there's another project. And so all of those things have sort of rolled up into this increasing administrative expense. These are just the numbers that would be on the first page of our budget update reports. So it wouldn't include the technology, it wouldn't include the investment expenses. That's just the first page. Legal expenses have gone up a bit. We've moved the actuary expenses into administrative expense aside the valuation charge. The payroll costs have gone up in the last few years. Insurance premiums have gone up. Strategic planning projects, contracts have gone up. So that's sort of the reason for the jump in 2024 there. It is sort of breaking the trend. This graph reflects 7 to 8% growth rates on the administrative fee. And we go to the next slide and we see the investment sales for operations. Now this is the number that I think of when we're talking about what cash flow is needed. Even though it could appear that we maybe use $8 million or $9 million a year, as Trustee Jurdy has referenced, in reality, we actually pull more dollars than that because every month we need to have a little bit of money sitting on the balance sheet to ensure that we can pay for unknown refund requests or a death benefit. And so in this case, 2024, I do have, this is the actual number here, and that's why it's in blue. 2024 is quite a bit higher than it has been in the past recently. And the reason for that is that this year we had several large refunds. We had several large death refunds. We had several large death benefit payments that we had to make. Then we just don't know, when those are going to happen. But those items alone throughout the course of the year, and what I call large is anything over $15,000 per person. That's large to me. And we had quite a few of those, and so we basically ended up spending over $1 million more. I shouldn't say spending, but we had to pull $1 million more than I really was expecting to have to pull throughout the year as a result of all of these things happening.
So Robert, can you just clarify what that would be? So maybe someone is not vested in the plan, they leave county service, they don't get reciprocal reciprocity established with another agency, and they say, okay, I'm never going to get I'm not going back to work at the county of Mendocino. I just want my money back. Is that what you're describing?
Yeah, it's exactly that. And I couldn't tell you why people do that. There's vested folks that do it too. I mean, I don't know.
That's more rare, but correct. Those refunds are people who left and they're taking their contribution balance out. The death payments, we had a couple of active deaths. Those involve both a death benefit payment and, in these instances, a refund of the member's account balance. Those were both sizable transactions. So those you can't necessarily plan for. And those refunds were perhaps a little bit larger than I think, prior years, maybe by $100,000 or so, but the timing is such that we had a higher cash need than perhaps was expected. And again, on this slide, I want to point out, this has to do with investment sales for operations, so it does not necessarily include the dividend distributions where we had turned off automatic reinvestment, or does it?
It could,
Okay, I wasn't sure from the title.
Yeah, I do consider that money coming out of the investment pool comes out for one reason, to pay benefits or administrative expenses. So I do consider that, and that is included in this. The number was like 10.6 something, 10.62 something $1 million. And then the last two slides here just sort of show the comparison to cash on the balance sheet to net position. We want, in the past, it was an issue that we had some significant cash drag, and we want to make sure that that's not happening anymore. And it's not. So you can see that the 2013 to 2018 numbers are a fair amount higher, even though the percent is low, 30 basis points. We're now getting that down to, below 10, 2, 3, 5. And I would point out that in 2022, that large cash balance was because of the where the payroll dates fell. And so that wasn't like we were holding extra cash for something we thought we needed. It was just that payroll date happened to fall within fiscal year 2022. So that would be the explanation for why it's 26 basis points instead of maybe 10 or 5. But that's specifically a number that we shoot to keep low. And then the final page here shows the cash outflow to net position. Doris and I sort of debate on this slide a little bit. I think this is underestimating what our cash needs actually are. And not that Doris doesn't agree with that, but we talk about this slide a fair amount. And so for clarity, this net cash outflow of $8.4 million is just the cash outflow from slide 2 and 3. So it's not what I would consider to be the actual dollars we need for operations. This is a mathematical formula based on the table from previous slides, from slide 2 and 3. So this 8.4 million, if you go to slide 2, you can see that the net cash outflow, which is just based on a formula of contributions minus benefits minus refunds minus administrative expenses, equals this negative 8.4. Slide 3, I'm sorry. Slide 3. So there's the 8.4, and so you can see that. When in reality, it's a little bit higher than this if you were to find me on the street and ask me that question. But it's still very positive, very low. It's a low number regardless of how we report that. And it shows that the system is healthy, that the funding policy is strong, and that the decisions the board has made over the past decade have been a net positive.
Yeah, so this slide, the important item on the last slide, slide 9, is that ratio of outflow to net position. So we are a cash negative plan. We pay more in benefits than we have in contributions coming in. So we do pull money from the portfolio, and this is showing you that the amount of assets we're drawing is relatively low because our net position there of cash outflow to our position is in the 1% range. It's not exactly our negative cash flow number, is it?
It's not.
Yeah.
But the concern would be once we get to 3.5%, that's when we go, what's going on here? Now we're thinking a little more carefully about what's going on. But we're a long way from that
but it's not an issue of concern as denoted by these numbers.
Can you go to slide 5, and at the risk of asking a silly question, I'm trying to explain and make a logical conclusion in my brain why every December and June there seems to be a huge difference and an adjustment.
3 payrolls.
3 pay periods?
Yeah,
Okay, because I saw in 24 it's a different month. It's in May instead of June. So it's the different timing of the 3 pay periods
Yeah.
in 1 month?
Yeah.
Okay, thank you.
Yeah, and the low bars there are the accruals. So those are lower because part of pay period 14 gets accrued to the previous year.
I knew there would be a logical explanation. I wasn't coming to it in my brain, so thank you.
Is there any further board member discussion? Trustee Jardy?
So yeah, so slide 5 shows the contributions from the plan sponsor and the employees would be at that same time period, I would imagine. But you have a chart that also shows, where dividend and yields come in, because those can't be totally inconsequential.
Well, they're not, but those numbers would be included on slide 7. So in 2024, that number's a 10.6 million, and that would include dividends and money coming out of the fund. So it's not necessarily how many dollars in dividends did we get in total. It's just how much did we have to take out of the investment portfolio to run and pay benefits.
Yeah, so I guess the thought I have, I think this is really good information. I'm just saying, to me, what would be add to it would be to look at, this is showing net cash flow out of the fund. How much of that could be achieved just by the dividends and the bond yields? I know for functional purposes, you tend to rebalance and sell assets and buy assets. And I realize that has to be done with the rebalancing process. But I'm sure someone else could explain the math to me. But when I've gone on Portfolio Visualizer and used quarterly rebalancing versus annual rebalancing, which I think they're timing with the dividend payments, it seems to minimize perhaps the amount of rebalancing that takes place, and therefore, for whatever reason, historically, it's shown that you actually get a little better growth rate in your plan. I don't know, again, I don't understand the math behind that, but I don't know, is that something that financial advisors talk to each other about? I mean, about, what is the optimal timing for rebalancing? Do you do it at the time the dividends and yields are paid out, because then you perhaps end up selling fewer assets and buying fewer assets because there's some cost and opportunity loss perhaps in doing that?
Well, there are a number of things to consider. There are operational concerns, and there are, maybe accounting concerns, although I would say that's much lower on the list. The primary driver of when or how we're going to do a rebalance is essentially the asset allocation and how close we are or aren't to that asset allocation. I mean, that's factor number 1, probably 2, and number 3. Any higher order factors, or lower order if you want to say that, those are all dependent on what time of the year. Some funds only pay out once a year. Other funds pay out twice a year. Other funds pay out monthly. So, we have a variety of different payouts happening at any given time of the year. And depending on things like our asset allocation and what's happening in the market, those factors sort of all come together to determine how we're going to do a rebalance.
Trustee Jardy, one reason that in the illustration on Portfolio Visualizer that the quarterly rebalancing perhaps outperformed annual rebalancing is the trend of stock assets have been going up over time. So by doing the quarterly rebalancing, you're buying at a lower share price, and therefore you're obtaining the gains on those new purchases as those assets continue to rise versus doing it only once a year. So that could be part of what's going on with the portfolio visualizer illustration. I don't know specifically what their assumptions are, but it could just be in part timing.
It's a question I don't have the answer for, but I just thought it's worth asking.
I mean, in terms of the dollars, you know, the distributions that we generally immediately reinvest is way more than $10 million. I mean, we're talking 20, 30 million in distributions. You know, theoretically, we could take all that money out. I don't think that's not what I would recommend we do at all. I've seen other organizations that do that, and it has not worked out for them, frankly. Their asset balances are where they were a decade ago. That's not what we want to do at all. We want those funds immediately reinvested, and we want to be strategic about picking and peeling out what we want to do, when we want to do it.
So I have a question on slide 3. Why does the contributions and the benefits from 24 to 25 drastically jump versus other years? It's at like 4.6 versus 1.45.
So contributions from
We go from
41 to 46.
46.
That's a function of the increase in contribution rates and an assumption that covered payroll grows at 3% for the county, for instance. So there's a slight growth in covered payroll. Now, in reality, that may not happen. It could happen, you know, in other years. So, for instance, between 22 and 23, payroll didn't go up very much.
But then from 25 to 26, it only goes up $1 million and 1.4.
Yeah, that's because the same rates are used, and so the only incremental change is
So
the
it's just
increase in
changing the rates.
payroll,
Okay.
right? I don't know what 26 is going to be in terms of contribution rates. So the contribution rates for 25 projection are used for the following year, 26. And only the base payroll wages change. Whereas between 24 and 25, base payroll and contribution rates. And so that would sort of be the same on the benefits paid side as well. It's not short.
Is there any further board member discussion? Is there any public comment? Okay, let's take a break, and it is 7. We could return. 7 o'clock? Is that okay?
So 10-minute break?
Okay. Our next agenda item is the board policy review. Director Rentschler.
Thank you, Chair Cavaness. There's a cover memo to give you the updates on 2 policies are being brought for review. The error correction policy had been postponed while we were waiting to see the impact of the Secure 2.0 changes. We've decided, based on the advice of counsel, to wait on bringing back the policy changes. So this is just readoption of the policy on its routine schedule. There were no substantive changes to that. With the error correction, with the trustee education and travel policy, the edits reflect the changes directed by the board at, I want to say, the May meeting regarding reimbursement to trustees for certain types of pension investment related materials such as the Morningstar software. So with that policy, within the board's direction, I put in some specifics like the limit of $400 and a couple of suggestions as far as what might be approved types of periodicals or subscriptions. And at this point, the board is welcome to edit any of that part if you want to change the amount, or you can adopt it as is. It certainly can be edited at any point in the future by board action.
Is there a motion?
Well, I appreciate the changes. I think they're helpful. And I won't be claiming any of this. I'll be leaving the board in a few months, but I think it'll be helpful for future board members and current board members. So I would move to approve.
Is there any discussion on the motion? Please do the roll call.
If I may, just for clarification, is that on both policies? The motion for both policies?
Yes.
Thank you.
Okay, I'll proceed with the vote. Mr. Kelly? Ms. Cavaness?
Yes.
Mr. Jurdy?
Yes.
Mr. Cromer?
Aye.
Ms. Harris?
Aye.
Ms. Pierce?
Yes.
Approved.
Okay. Agenda item 5, annual unrecovered benefit overpayment and underpayment contributions report. Executive Director.
Thank you, Chair Cavaness. This report is required by policy, and it's just to let you know that in this past fiscal year, we had no benefit overpayments that were deemed unrecoverable, so there was nothing to report. I did want to mention that going forward, should MSERA recognize some benefit payments as unrecoverable, we could file a claim on our fiduciary insurance policy that does have a sublimit coverage of up to $100,000 for benefit overpayments. There's no action required on this, but I will answer any questions if there are any.
Seeing none, is there any public comment?
There is no public comment.
Okay, thank you. Item number 6, the administrative report with Executive Director Doris Rentschler.
Thank you, Chair Cavaness. The construction update is that we do have our permits issued. We have a tentative schedule starting August 12th for work on the building for those access improvements. MSERA's parking lots will be under construction and limited as far as access during a period of time starting in mid-August. As far as the pension gold updates, we are proceeding with a customization on the split account functionality to correct the way interest is divided. And then we're also continuing to work on the new print capacity for checks. The application the county previously used is being phased out, and we're looking at moving to PDF print to print the checks. We have had some issues with the bank saying the MICR alignment is not quite correct. We continue to address that with our service provider, LRS. We have continued to send notices out on the member confirmation status project. We sent 151 notices on June 19th, and as of July 12th, we had already received 93 responses. Progress on that has been very good. We just decided yesterday to send out the next batch based on age, and that 190 notices, I believe, went out today. So we found that the responses have been very quick for most folks. Very few need an alternate confirmation method, and there really has not been any undue hardship on the retiree population to confirm that they're still living and entitled to benefits. So that was pretty much it for the admin report. I did want to point out one thing regarding our newsletter. Although the newsletter does report, quarterly report does give you some click-through rates, those click-through rates reflect only the links that we use every single month, because some are a one-off, because it's only in one newsletter, like the month when we had an update regarding the membership survey done by Problowski Research. That newsletter article, which linked to the same presentation the board received, had 558 unique clicks, so it does drive some content. We've had other instances in the past where a particular article on like wildfire safety drove an unusually large number of clicks with any particular newsletter. So I just wanted to point out that the newsletter is reaching a fair portion of our membership. Not only do we have good open rates, but some of the content is actually driving member engagement. There is a legislative report from Sackers, and I'm happy to answer any questions if you have any.
Seeing none, is there any other board member discussion on the administrative report? Okay, is there any public comment?
No public comment.
Okay, item number 7, is there any general board member discussion? Seeing none, we're going to go into closed session. The board will move to closed session for the following items. A, conference with legal counsel, anticipated litigation, significant exposure related to litigation pursuant to Government Code 54956.9 D2, multiple cases threatened in response to historical benefit review project implementation. Implementation. I can't talk anymore. Okay. And then B, conference with legal counsel, existing litigation pursuant to Government Code 54956.9 D4. Name of case, Ventura County Employees Retirement Association, Criminal Justice Attorneys Association of Ventura County et al., California Supreme Court, case number S283978. Okay, I'm going to go into closed session.
Thank you.
So the board met in closed session on 2 items. On the first item, 8A, the Historical Benefit Review Project, the board gave direction to staff and council. On the second item, the existing litigation, B. Sarah versus Criminal Justice Attorneys Association, the board met in closed session and discussed whether or not to file an amicus brief in this action. And the motion would be, yes, that MSARA should join with other SERL systems and file an amicus brief in support of this litigation. And for the public, I'll just briefly mention that this case involves the issue of straddling of vacation pay and to limit that amount that can be added to pensionable compensation to the amount that's actually earned and payable within 1 year. So would somebody like to make that motion?
I'll move to approve submitting an amicus brief on the case.
I'm sorry.
Roll call vote.
Oh, yeah.
If
Roll call
public
vote.
comment, if
But
there's any.
and maybe we should clarify, the amicus brief is in support of prohibiting the straddling, sort of doubling up of the vacation cash out.
Yes, and to file an amicus brief in support of that.
Is there any public comment?
There's no public comment.
Okay, can we have a roll call vote?
Mr. Kelly? Ms. Cavanagh?
Yes?
Mr. Jurdy?
Yes.
Mr. Cromer?
Aye.
Ms. Harris?
Aye.
Ms. Pierce?
Yes.
Approved.
Okay. So, that concludes our meeting for this month, and we will, next month, our next MSARA meeting will be held August 21st, 2024 at 8:30 a.m. Thank you. Here, yes.